Last time when we launched workshop registration, more than 350 people have registered. Over the past 2 months, we have successfully completed the workshop for all of them. Now we are launching new registration for next 9 batches, and the link can be found in the description. Hi, this is PR Sundar. During the coronavirus time, more and more people are coming into stock market trading, and many brokerage houses opened so many new demat accounts. And I always tell my friends, there are 2 fields which are glamorous. One is the movie industry, the other one is the share market. But in both places, there are only few people achieve greater success, whereas most of the other people are suffering. A statistic says 95% of the people lose money in stock market. And the moment you tell this, then people always say, sir, you keep it for long term. Long term investment is always good. Let me tell you, long term investment is a myth. Why? Let me give you some historical background. NSE India started in 1994. National Stock Exchange of India started in 1994 with a base index of 1000, and now it is trading nearly 11,000, which means that on an average, if you have invested 1000 rupees in 1994 and today it is worth about 11,000. Please remember, I am talking about the average return. Average return of the top 50 companies in India. Anytime any company is not doing well, that company is thrown out and another good company is brought in. So in a way, we are considering only the 50 winning horses, and then we take the average. People can say, sir, if you have invested 1 lakh in Infosys, that would have become 1 crore. But I can give you 10 examples where if you have invested 1 lakh, that has become 1000. So how do you know which stock will perform in future? So for the calculation, we take the average return of Nifty. Believe me, in the last 25 years, the average return of Nifty is actually less than the average return given by a public provident fund, which is a debt instrument where there is no risk involved. Just to give you a simple example, now you go and put the money in bank FD, it may double in 8 years. But during 1995, there was a very famous instrument called Kisan Vikas Patra. You put the money doubles in 5 years. 100% guaranteed, government instrument. So, in economic cycle, sometime your money doubles in 5 years, sometime money doubles in 6 years, sometime money doubles in 8 years. So, for simple calculation, we take on an average, money doubles in 6 years in debt instrument. And believe me, in 1995, I put bank FD where I got 21% interest. That's a different story. That is an NRI money. So those days, India faced a lot of problem with the foreign currency. So they offered higher interest rate for NRI deposits. If you assume that money doubles in 6 years, from 1994 to 2020, it is about 26 years. Let us say it is 24 years. It has a 4-6 year block. Had you invested 1000 in debt instrument, in 6 years it should have become 2000. Next 6 years, 4000. Next 6 years, 8000. Next 6 years, 16,000. So now the Nifty is not at 16,000, it is only at 11,000. So the stock market return has not doubled even once in 6 years. But here you carry a lot of risk. Whereas the debt instruments, you don't carry a risk. So, the stock market is only for two people. Those people who can identify the stock that can perform well in future, or for the people who know when to get in and when to get out. And there is a general perception that you buy, leave it for long term, you will be good. That is not true. Simple example, so many people have invested in Anil Ambani companies. Their argument is that this is from number one business family in India. But what happened to their investment? All have lost 95 to 99% in terms of price value. Forget about the time correction. So, therefore, always remember, stock market is not as glamorous as you are thinking, and long-term investment is a myth. Thank you for watching. We'll come out with another video soon. Thank you.